Well, hello everyone, and welcome back to Reflections in Real Talk. I'm Judy, and today I'm going to talk about one strategy to simplify investing, choosing one single fund that allows you to set up a diversified investment portfolio with literally thousands of stocks and bonds on your own quickly. This is an option anyone planning for their retirement should learn about. One of the hardest things to do when it comes to saving for retirement is just getting started. With so many options, it can be hard to get started or just to be sure what to do first. Target date funds might be a solution for you if you want to get started and want a simplified approach. So if you're just getting started with investing or refining your retirement strategy, this episode is for you. So grab a cup of coffee or tea and let's get started. The idea of a target date is simple. You pick a fund with a target date that matches the year you plan to retire. For example, if you're aiming to retire around 2050, you might choose a 2050 target date fund. This fund automatically adjusts its mix of stocks and bonds and other investments over time, becoming more conservative as you approach retirement. Why would you consider a target date fund? Target date funds are popular for a few reasons. Simplicity. They offer a one-stop shop for retirement investing. Professional management. The fund managers handle the allocation adjustments for you. And customizable risk. They can be tailored to your preferred level of risk tolerance, which brings me to an important point: lower fees. If you purchase a target date fund on your own, you can avoid paying additional fees to a financial advisor. Of course, there's still fees associated with fund management. Choosing the right target date fund. When choosing a target date fund, there are two main approaches that you can take. The first option is to pick based on the retirement horizon, as I said earlier, just choosing a fund with the target date closest to your expected year of retirement. Again, for example, if you're retiring in 2045, the 2045 fund might be right for you. Option 2 is to pick based on your desired allocation. So if you're more focused on controlling the level of risk in your portfolio, don't limit your search to the year you plan to retire, but rather look for a fund that matches your preferred mix of stocks and bonds. For instance, a 2060 fund will be more aggressive than the 2040 fund to get the right asset mix allocation, but make sure you review this allocation for each fund before you buy it. Let's take a look at two funds side by side. So today we're going to compare two popular target date retirement funds, one from Vanguard 2060 fund, and the other one is a Fidelity 2060 fund as well. And I'm using the Fidelity website, so it's understandable that they're automatically going to populate the search tool with one of their funds for the side-by-side comparison, but you can easily search for other funds for the same comparison approach. First, let's take a look at some of the basics. The minimum investment required for the Vanguard Retirement Fund is $2,500 to get started. It's a relatively low barrier for new investments. But the Fidelity 2060 Fund has no minimum investment required, making it more accessible for those who are just getting started on their investment journey. Next, we're going to look at expense ratios, the silent but significant factor in your fund's performance over time. The Vanguard VTTSX has an expense ratio of just 0.08%, which is one of the lowest in the industry. This means you'll pay only 80 cents annually for every $1,000 you invest. On the other hand, the Fidelity comes in at 0.12, which translates to $1.20 per 1,000 invested each year. And while this difference might seem small, over decades, it can significantly impact your overall returns, especially with compounded growth. Now let's look at some of the performance metrics. And here are the rates of return as of the most recent data. So the Vanguard over 1 year is 14.63, whereas the Fidelity is 14.17. For 3 years, the Vanguard is 4.38 and the Fidelity is 3.84. 5 years, 9.02 versus 8.60, and 10 years, 8.7 versus 8.66. As you can see, Vanguard's fund slightly edges out Fidelity's across most timeframes, though the differences are relatively small. So how do you choose between these two funds? It ultimately depends on your priorities. If keeping costs as low as possible is your top priority, the Vanguard 2060 fund might be the better choice with its lower expense ratio. If you're just getting started and don't have much to invest up front, the Fidelity Index 2060 fund offers greater accessibility with no minimum investment required. Both funds are well diversified and professionally managed, making them excellent choices for long-term growth. And there are literally hundreds of other choices to choose from just on this Fidelity site alone. Advantages of single fund strategies. Target date funds also come with some additional advantages that make them appealing, especially for those looking for convenience. Automation. You don't have to worry about rebalancing your accounts every year to maintain that asset allocation. The fund does the work for you. Diversification. Single fund portfolios provide a diversified mix of investments in different asset classes and securities. And while diversification doesn't ensure a profit or guarantee against loss, it does help to spread the risk. Disciplined investment approach. Managing your own investments can be challenging, especially during volatile markets. Most fund managers follow a carefully developed investment methodology, helping you stay aligned with the fund's objectives and avoiding emotional decision making. This can help you stay the course during a bear market when funds go down, so you can take advantage of the upswing during recovery periods. Professional oversight. With professional management, you benefit from the expertise of seasoned investment professionals. They will adjust the fund strategy as needed. So here are some key questions to ask before choosing a fund. Ask yourself, what is my expected retirement date? How much risk am I comfortable with? Are the fees for this fund reasonable? And remember, lower fees mean more money stays in your account. What is the expense ratio? Expense ratios can significantly impact your long-term returns. Look for funds with lower expense ratios to minimize costs. How does the fund's allocation compare to others with the same target date? And finally, before investing, take time to review the fund's investment objectives, risk, charges, and expenses. This information can usually be found in the fund's prospectus. If you want to invest your money in companies whose mission and vision are ones that align with your personal, ethical, or environmental concerns, on some sites, you can filter for green funds. This filter uses Morningstar data to define funds that are part of either a sustainable investment or employs exclusion groupings. Morningstar defines an investment as a sustainable investment if it's described as focusing on sustainability, impact, or environmental, social, and governance. Lastly, watch out for higher fees, and here's a tip to help you save more for retirement. Be aware of how investment firms market their own target date funds. For example, companies often promote their own target date funds prominently on their websites. These funds can have higher expense ratios compared to other options from competitors. You may need to dig a little bit deeper in their website to find lower cost alternatives. Don't just click on the first one that shows up on the page. And why does this matter? A higher expense ratio might seem very small, but over time, these fees significantly eat into your investment returns. By actively seeking out funds with lower costs, you can keep more money working for you. And when selecting a target date fund, it's crucial to consider that expense ratio, as higher fees can significantly impact your investment returns over time. Now, it's important to note that while low fees are beneficial, they should be considered alongside other factors such as fund performance, investment strategy, and how well the fund aligns with your retirement goals and risk tolerance. Always review the most current fund prospectus and consider consulting with a financial advisor if you feel uncertain to ensure that a particular target date fund is appropriate for your individual financial situation. So whether you're looking for a fund that aligns with your retirement date or one that matches your ideal investment mix, target date funds can be a powerful tool in your financial toolkit. And as always, take the time to do your homework and consider speaking with an advisor to find the right fit for your unique needs. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with somebody planning for retirement. And let me know in the comments, are you currently investing in target date funds? What's your strategy? Until next time, take care and keep planning for the future.